HDFC Life has a new person in the corner office, and the numbers do tend to favor the largest private sector life insurer as well. Can the rising competition from newer players and newer distributors who typically undercut on premiums to capture market share upset the apple cart, or will the leaders continue to become larger? What is the new CEO's roadmap to protect what is their own territory? Let's ask the person herself. Ms. Vibha Padalkar, the new MD and CEO, joins us right now on the show. Ms. Padalkar, good having you. Thanks so much for taking the time out. You have a very strong legacy to continue. We were looking at your numbers, highest VNB margins as of Q1 FY19, the net profit 5-year CAGR, highest amongst the private sector players, highest valuations as well, and maybe you need to do a lot more to live up to those two. How do you see and how do you set the roadmap as you take over from Amitabh Chaudhry in about a couple of months' time from now?
So I have already taken over, but in terms of the overall growth, what we have in terms of penetration in India today is woefully inadequate. We used to be a lot higher, about 4.6%. That's gone down to 2.8% as an industry. So really, rather than worrying about growth, because that is inevitable in India, wherein both in terms of protection, so the protection gap is 92%, which means out of every 100 rupees what people have overall as protection is only 8 rupees. Also aging population, slowly but surely, so we will have double the number of senior citizens in about 20 years. So that itself shows that people under the age group of 20 is going down, over the age group of 65 is steadily increasing. So the need for 3 tenets of protection, which is mortality, morbidity, as well as longevity, is certainly something that would be required, and we would be able to come up with innovative products, withhold in terms of our market share on our existing distributors, as well as tie up with new distributors, which is something that we have been very confidently been down that path, and having tied up with 163 distributors, traditional distributors, as of the end of the first quarter. So really continuing on that journey that we set out about 5-6 years ago.
Interesting. So, I take on board that point. I think 163 bank assurance partnerships, 26 non-traditional partnerships as well. Is this a sign of things to come, or would you believe that going digital, digitization, and getting people to invest direct is the bigger trigger of growth for you as a company? Or not just necessarily over the next 2 quarters, but let's say over the next 2 or 3 or 5 years.
The way we see in terms of how our distributor shares pan out, we would like each one of the significant contributors to grow in a manner wherein it fulfills the potential of that particular channel. So even the ones that are traditional in nature, like our agency channel, has been tracking growth of about 25 to 30%. No reason to believe that will not continue, especially given that we have succeeded in making our agency channel perhaps the most profitable at company level margins. Same thing with our direct channel, wherein the share of our direct channel has gone up very significantly. It used to be around 10-11%, gone up to 19%. So have seen some addition of partners there, including our own indigenous upselling to our existing customers, both in terms of online as well as branch walk-ins and other modes of touch points. And also the new tie-ups. So new tie-ups will also continue, both in terms of new ecosystems, like you mentioned, all the fintech companies, the cab aggregator companies, companies that sell online. These are all the new ecosystems. So really it is a multi-pronged approach as against just one or the other.
Fair call. While we are on that topic, just a question that seems to be bothering select sectors, and your view out here would be really welcome. HDFC Bank opening up the access to some of your competitors as well. Now, people are undecided. There are some who believe this could be a possible long-term negative for an HDFC Life. Would you agree?
I think, like I mentioned earlier, first of all, this open architecture was something that HDFC Bank had communicated for a very long time. So this news really has been a factored in news, and which is why our quest to tie up with several other partners as well in an open architecture model, and we have been very successful in getting to the 163 number plus the 26 in the non-traditional, and we would like to believe that in the private sector we are perhaps right up there in terms of number of partnerships that we have, and this is just the beginning. So 9 out of 10 small finance banks that we have tied up with. We have tied up with both the banks that have got the recent banking license. Every marquee NBFC that has agreed to open up, we have tied up with. So, so really it is a question of how do we expand our distribution as against have all our eggs in one basket. At the same time, we want to offer HDFC Bank the best value proposition, and this isn't really only after multi-tie scenario happened. It was all along wherein we would like to believe that we gave them the best value proposition in all aspects, including in terms of the technology focus that they've been having recently in the last maybe 2-3 years. And so that will continue, and what might be perceived as a disadvantage of multi-tie is also our advantage, as is evidenced by our recent win with Vijaya Bank, for example. And we would like to believe that that trend of also making inroads into tie-ups with other public sector banks will continue. Sheer strength of what we can do on the bank assurance, and we are perhaps the market leaders in that space, would mean that it is a no-brainer for even other banks to, as and when they open up to multi-tie, that for them to choose us as one of the partners.
Which I don't think anybody would contest. But Ms. Patelkar, a small follow-up to that. You mentioned that you would continue to grow through all kinds of associations and partnerships as well. Let's assume a 5-year scenario. Would you believe that the nature of growth would entail expenses which are higher? Yes, I know expenses go up as more tie-ups, etc. happen, but would the rate of growth of expenses in order to facilitate these tie-ups and nurture them over a period of time be slightly more than the growth that they bring in the short term? And by short term, I mean the next 3 or 5 years. And therefore, is it possible that while we see growth grow, we might see expenses grow at a slightly faster clip over the course of the next 5 years?
So what you're saying is right from an Indian GAAP perspective, because Indian GAAP as it stands today does not allow us to straight line the expenses. And insurance is a long tenured product. So if I were to straighten the expenses like it is in under some of the other accounting standards like US GAAP or IFRS to some extent, then those expenses would get straight lined. But because Indian GAAP as of today does not allow us to do that, so in a high growth scenario, expenses will have to be booked to the P&L as they are incurred. And so while the expenses, it is very possible that expenses might grow at a slightly higher clip as we tie up with more partnerships. But what you will certainly see is that the post over a new business margin would continue on a smooth upward curve. And that is really what is important, because the new business margins take into account that the expenses incurred, all things being equal, would be straight lined and the profits would flow through. So that's something, and the fact that we ended at 24.2% new business margin in the first quarter, we would like to believe our industry leading margins, and these are fully factored in margin with all expenses being booked of every kind. There's not a single rupee that is not reflected in that margin. So it's so we would like to believe that while there would be investments that are required to be made for growth, both of a here and now operating expense as well as capital expenditure on technology, but new business margins would continue on a smooth upward trajectory.
Okay, just a two-part follow-up on that. One, does this have a sweet spot or an inflection point of sorts wherein you keep on investing and the expenses would grow at a particular rate, even as per Indian GAAP, for example, for a particular period of time, and then the revenue growth has such a nice smooth up curve that it takes care of the growth in expenses as well? And part two of my question, you mentioned about these margins looking up at 24% in quarter one. Is there scope to take them higher in the near term itself?
So as far as the expenses, yes, with scale, the level of expense growth will come off. But Having said that, HDFC Life, our P&L reflects every rupee, like I said. Unlike in a lot of other life insurance companies wherein there might have been some structuring that is done at a shareholder level or some other kind of alignment between your biggest distributor and the life insurance company, etc. Which so the life insurance expenses don't fully reflect what market commercials demand, and hence HDFC Life might take a little bit longer to taper off on the expenses. Also, tapering off on expenses isn't too difficult in life insurance industry. At one point in time, we were down to 10.2%, and getting to high single digits would not have been difficult, but that would have meant not investing in all the things that we are doing, whether it is in the field of analytics, robotics, in terms of exploiting the power of fintech companies, in terms of being able to enable our agents to go to the customer to service. So the entire gamut, when we would like to believe we're again being the market leaders, would not have been possible had we taken a very here and now quarter-on-quarter view to say what do we do on expenses. So your second question on the margins, margins are a function of what we sell, and with product innovation, that again, that's a focus that we've been doing on the three tenets of protection. If we continue to focus on that, and again, that's something that we have been coming out with a lot of innovative products, especially a breakthrough deferred annuity product that we launched recently, about a quarter back. Is something that would help us to expand margins. So the focus for us is, along with cost efficiency, to also see how we can exploit or take advantage of pools of profitability which are up to now relatively untapped. And we did that when we looked at our Credit Protect segment of covering or insuring loans that are taken by customers. We looked at our pure term online proposition. We looked at how do we sell the likes of cancer care. First of all, conceptualize, manufacture, and then sell the likes of cancer care, cardiac care, which are lifestyle illnesses, and now finally the deferred annuity product that I just mentioned. So that also will mean margin expansion and will help in that.
Interesting. But wouldn't the rest of the industry catch up with these products very, very quickly? Typically, how long would a first mover advantage be for you, one on the growth, two on the help that or the aid that it does to your margins?
Absolutely right. So we have been market leaders in innovation, and both, like I said, in what we sell and how we sell, and there is a catch up. So as soon as things become public, our management mind share has already moved to the 10 things that we are investing in at any point in time in terms of big bets. So yes, we have to continue to run to stay in the same place, and that is inevitable in an industry that really does not have very much of trademark or copyright. Products can be copied, but I think the brand also helps in a big manner. So it's not just the same product offering, but it is the trust. Insurance ultimately tends to be an emotional buy and lesser of a cerebral buy. So it's an entire package when you go with an offering.
Interesting. Is cross-selling now becoming bigger and bigger for you? I mean, a lot of other companies in other sectors, I mean, the Bajaj Finance is a classic example of they saying that we are getting more and more from our existing customers. Now, I know, I read up one statistic which said that the cross-sale base for you, policies from existing group customers to total new individual policies, has increased to about 7.7% from 1.6% in FY15. Maybe my numbers are a bit off here and there. But what's the scope of this improving further? And I'm guessing that would be a lot more cost effective for you as a company.
It is, and also a happy customer is a customer who will, the propensity to buy is that much more. So you're absolutely right in terms of the numbers that you mentioned on our ability to upsell to our Credit Protect customers. So those customers might not have had any relationship with any of the HDFC Group companies, and yet we are able to upsell to the customer. But it's not just upsell, it is also the use of analytics, it's the use of a lot of algos to come to sensibly upsell as against just carpet bombing. We also do a lot of nudges, maybe 3 or 4 nudges before the customer realizes the need to protect in some manner. And when the customer finally buys, he or she thinks that it is their decision to have done that. So using various modes in which for us to upsell to the customer. So our customer base is there. We are also working on a 360-degree view of the customer. This also means that when a customer enters or transacts with any of our touch points, we are able to know the temperature of the customer. Is there a lot of angst? Is this a happy customer? Has he or she moved in terms of their own personal situation? What are they looking for? And also through the new ecosystems for us to get a sense as to what is the DNA of the customer now as against when we sold the first policy. So a lot of these touch points which we are intensely working on to ensure that we upsell or cross-sell the right product at the right life cycle for the customer.
Interesting. One thing that I hear a few skeptics, I mean, purely from an investing perspective, I'm talking about, Ms. Patalkar, people who are trying to invest into the life insurance space talk about one factor which is not turning out to be the best for the space in general, and that is the 61-month persistency ratio. For you as well, it may have gone up a little bit in Q1, but by and large, if I look at the trend for the last 3 or 4 years, I think for you as well, the 61 persistency ratio would have come up. It's come off for the industry at large too. How valid is this concern? Because people may be coming in for year 1, maybe year 2, so the 13-month might be looking okay, the next period might be looking okay, but it's not necessarily lasting for 5 years. How realistic is this concern?
It is factually correct because that's what our 61st month persistency shows, especially for the last year in FY18. That particular cohort, which is what we sold 5 years ago, had started off at a disadvantage, wherein that the 13-month persistency of that cohort, which is today at 61st month, was at 69%. So we have been at a disadvantage, started off at a handicap, and since then we have been collecting at over 80% year on year. So we have stemmed what we started off at a disadvantage. However, the trends that we are seeing in terms of the next cohort, which have completed 4 years, they are trending a lot better than these numbers. So once this particular cohort, which is at the 61st month, exits our system, the next cohort that comes up will start showing signs of improvement. A lot of it depends on the product architecture. There are very little exit barriers today, especially when you compare with the likes of some of the other economies like China. And so it is a struggle to withhold, especially in the unit-linked space, lesser in the non-participating and participating product space, but in the unit-linked space, there is a 5-year lock-in. So there's an event that happens which perhaps nudges the customer to think as to do I want to continue or not. And exit barriers, like I said, even during the 5 years are woefully inadequate. And so some of these structural changes, if they are done even at the fringes, could help us get to above 90% on the 13-month persistency, and consequently get the 61st month persistency significantly higher. So some of it is structural, but one would see, not just for us, but I would also hazard a guess that industry as a whole is largely focused on getting persistency right, a lot more that they are aware today of the impact of a happy customer, as well as impact on our overall profitability if we get that right. And so there is a lot of focus.
Maybe valuation as well. But just wondering, so when does this next cohort, I mean, I don't know if we can time it, but do you reckon FY19 onwards, you will have a much more stable and a higher 61-month persistency ratio, or would it get pushed from FY20 onwards?
No, from FY19, the trend should start looking positive. It'll certainly improve FY20, but in FY19, there's a mid-year impact. So the full impact of that would start panning out from FY20, but FY19 also you should start seeing green shoots in terms of the 61st month persistency heading upward.
I read somewhere, Ms. Patalkar, that you also as a company are focusing a lot more on single premiums now. Is that true, and the rationale thereof?
So it's lesser of focusing on single premium as a strategy. I think what we are focusing definitely, are a couple of things. One is on protection of both mortality as well as longevity. Mortality protection is which causes single premium to look a lot higher is in the space of Credit Protect, which is on a single premium architecture. So the way it works is if a person takes a loan, then the loan is covered. It's a single premium that's paid to us, and we cover the tenure of the loan. In terms of single premium, in the sense of in the non-participating space, which is the annuity and deferred annuity space, which looks at protecting longevity risk of people living too long. So there again, it is a single premium. So we receive a single premium and we pay out an annuity until the person is alive, or several variants of whether he's alive, his spouse is alive, etc. Again, on deferred annuity product, which I mentioned that we launched recently, that too is single premium, and we cover after a deferment period based on what the policyholder chooses. The annuity starts after a few years. So that too is single premium. So it appears that it's a single premium focus, but that's really an outcome of the protection strategy that we are focused on.
Okay, one last question, Ms. Padalkar, before we wrap up this interaction. You know, when you look at some of the other industries, autos, for example, the largest player is only looking to get larger. It's not that the 3 or 4 larger players are gaining necessarily at the expense of some of the smaller players, or the private players at the expense of the publicly listed players as well. How do you view this industry growing the next 5 years? Would it be the private insurers gaining over, or the large private insurers gaining over the public insurer and the smaller players? Or would it also involve you as one of the leaders gaining market share over the other large private players as well?
I think both, because like I mentioned, talking about us, we should continue to gain market share, because on the basis of us expanding our distributor tie-ups, our continued foray into the uncharted territory of tying up into new ecosystem, and as they grow, we piggyback on the growth, as well as focusing on expanding the product offerings, as against just talking about the 3 traditional products, which are unit-linked, participating, non-participating. So coming up with product innovation based on changing needs of the Indian customer, including lifestyle-related changes, socio-economic changes, etc. As far as the overall growth of the industry is concerned, no reason to believe, absolutely no reason to believe why life insurance industry, which anyway has gone down in terms of penetration, like I mentioned, to now very low numbers of 2.8% from a high of 4.6%, means that we can at least go back to the levels that we ourselves were. Also, when you read it in conjunction with rising per capita income, going similar footsteps, the way China has increased, also the relative disadvantage that some of the other financial services products are currently going through, as well as say where interest rates are headed. So for example, bank fixed deposits would be significantly less attractive than they might have been maybe 4 or 5 years ago. Means that there's no reason to believe that the savings that are coming into, first of all, into financial savings pool, and thereafter what is being attracted by the insurance industry should not go up. So the overall macro is very, very well suited to the growth of Indian life insurance industry.
Yeah, I wish you all the best for leading this growth in your new role. Thank you so much, Ms. Padalkar, for talking to us. Look forward to talk to you post some of your quarterly numbers as well.